Welcome to Iron Financial. So today, we are putting GE Vernova's entire foundation under the microscope. Look, they just dropped an absolute monster of a quarter, and the market is roaring. Our job, as always, is to find out if this structure is actually built to last, or if it's hiding some critical flaws. We're here to help you forge a stronger portfolio and cut right through the market weakness. All right, let's get to work. Okay, let's start with the headline numbers that are absolutely shaking the market. We're looking at total orders coming in at $18.3 billion. Now that's a 71% surge from this exact same time last year. You have to understand, in the world of heavy industrials, you just don't see growth like that. That's a tech-level growth number in a sector that builds 100-ton turbines. So this isn't just a beat on earnings. This is like a tectonic shift in demand. It's a huge signal that the capital spending cycle for the energy transition and, electrification, it isn't just starting, it's accelerating at a pace that has caught Wall Street completely flat-footed. The book-to-bill ratio was nearly 2-to-1. What that means is for every dollar of product they shipped out the door, they booked $2 of future work. That's the kind of forward momentum that makes professional investors sit up and pay very, very close attention. And all of that order surge, well, it feeds directly into this, the backlog. $163 billion. That is a fortress of future revenue. And look, this isn't just some number on a spreadsheet. It's a moat. It insulates them from economic downturns. To really put that into perspective, their expected revenue for this entire year is somewhere around $45 billion. So this backlog, it gives them visibility for the next 3.5 years, even if they didn't book another single dollar of new orders. In just one quarter, from the end of last year to the end of Q1, they added $13 billion to this mountain of future work. That is absolutely staggering. And it tells you that the momentum we saw in the orders isn't just some one-quarter fluke. It's a sustained build that strengthens the entire foundation of the company. And then there's the cash, an unbelievable $4.8 billion in free cash flow. Just look at that number. To put it in perspective, their entire free cash flow for all of last year was $3.7 billion. So they generated more cash in just 3 months than they did in the previous 12. In the world of industrial manufacturing, cash is king. And right now, GE Vernova is sitting on a throne made of it. And this isn't just about bragging rights. This kind of cash generation is ammunition. It's the capital they can use to invest, to fix their weak spots, to make strategic acquisitions, pay down debt, return capital to shareholders, all from a position of immense financial strength. All right. The headlines are massive. I see the numbers, and yeah, they're impressive on the surface. But you and I both know that big numbers can hide big problems. Anybody can post a huge order number, but the real question is, can they execute on it profitably? Is this a truly solid foundation? Or is it just some clever financial engineering designed to prop up the stock price right after the big spin-off? I've seen this movie before. A company spins off, pumps up the numbers for a couple quarters to look amazing, and then reality hits. So I need to see the blueprints. I need to understand the structural integrity before I'm convinced this thing isn't just a house of cards. Exactly, and that's precisely why we're here. At Iron Financial, we don't just look at the shiny exterior. We run a full stress test. We are going to peel back the layers and inspect the actual load-bearing walls of this company. So here's how we'll break it down. First, we'll look at the big picture numbers. Then we're going to drill into the 3 core segments: power, which has to be the bedrock; electrification, their supposed growth engine; and wind, the segment that frankly everyone worries is a major structural weakness. And finally, we'll issue our verdict. Let's see if this company can actually bear the weight of all these investor expectations. Okay, let's move to our first section and really look at the overall structure. The top-line numbers, they give us the first reading on the integrity of the quarter. This is where we check the main support beams before we go room by room looking for any cracks. So this slide here, it lays it all out. Let's break this down. Orders up 71%. We've covered that. Revenue up 7% organically. Now that's solid. But notice the enormous gap between order growth and revenue growth. That tells you the big wave of work is coming, but it hasn't all hit the income statement yet. This is a very powerful leading indicator. But the crucial point on this slide, the one you really need to focus on, is the adjusted EBITDA. It nearly doubled, up 87% to $896 million. And the margin, it expanded by 390 basis points. That's not just growth, that's profitable growth. In an inflationary environment, that is incredibly difficult to pull off. It tells you they have pricing power and they're managing costs effectively as they grow. That's just operational excellence. Hold on a second. A $4.8 billion cash flow number, that's an outlier. For any serious analyst, that's a flashing red light. The source material says they had a $5.3 billion benefit from something they call working capital. Now, that's Wall Street jargon that we need to translate. To me, that sounds like they could be pulling in cash that just isn't sustainable. Is this real, repeatable operational cash from selling things at a profit, or are they just pulling forward payments from customers and playing games with the balance sheet? I need to know if this cash is a one-time sugar high or if it's a sustainable part of the diet, because one of those is extremely valuable and the other is a trap. That is absolutely the right question to ask, and honestly, it's the most important one about this entire quarter. So here's the answer. The cash is coming from a position of strength, not from some accounting gimmickry. It is the direct result of higher down payments on that massive surge of new orders, specifically in the power and electrification segments. I mean, think about what that means in the real world. Customers are literally lining up and writing massive checks up front just to reserve manufacturing slots for things like gas turbines and grid transformers. This isn't just an order, it's a non-refundable cash deposit. And it tells you two critical things. The demand is real and it's desperate, and customers are so concerned about supply chain scarcity that they're willing to pay now just to secure their place in line. That is a position of immense power. Okay, let's move to our first drill down and see how this all builds. We're looking at the power segment. This is the bedrock of GE Vernova. It's the legacy business, the heavy iron, the gas turbines, the services. It absolutely has to be the cash-generating foundation upon which the rest of the company is built. This is the part that pays the bills and funds the more speculative growth ventures. If this part is cracked, the whole structure is compromised, no matter how shiny the other parts look. And this brilliantly illustrates its strength. Just look at the margin expansion on this slide. A 500 basis point increase in EBITDA margin in a single year, jumping from 11.6% to a very, very healthy 16.3%. Now, this is driven by two simple, powerful factors: better pricing on new equipment and higher volume in their high-margin services business. This is the result of that stunning 59% year-over-year growth in orders. So they are selling more, and they are selling it for more money. This is the heavy lifting engine room part of the company, and it's getting stronger and way more profitable. This is exactly what you want to see from your foundation: solid, stable, and just throwing off cash.
Okay, that margin jump is impressive. I'll grant you that. But a single quarter can be an anomaly. How sustainable is that 16% margin, really? Or did they just get lucky and have one or two very high-margin long-term service agreements hit the books this quarter that just skewed the average? I need to see some evidence of future durability. A strong foundation has to last for decades, not just for a few months of good headlines. So show me that this profitability has legs and isn't just some temporary boost from a few lucky deals.
That's a fair point. And the durability, it comes from the backlog and the quality of those new orders, which are increasingly long-term service contracts. And that actually brings us perfectly to the next segment. Let's drill down into the division that everybody is watching: electrification. So if power is the bedrock foundation, this is the high-tensile steel frame being erected on top of it. This is the growth story. This is the part of the company that's supposed to capture the future. We're talking the grid build-out, the data centers, the entire AI revolution. This needs to be not just strong, but nimble and growing at an exponential rate. The numbers here are just explosive. Orders are up 86%. Let that sink in for a second. This isn't some incremental increase. It's a step change in demand. Organic revenue is up 29%. And look at the profitability. Margins expanded by a massive 590 basis points. They are growing the top line at a breakneck pace and becoming dramatically more profitable at the exact same time. This is the definition of positive operating leverage. And the driver? It's a two-word answer: data centers. The demand for power and grid infrastructure to support artificial intelligence is completely off the charts, and GE Vernova is standing right in the path of that tidal wave of capital spending. Okay, the data center narrative is powerful, and that quote from the CEO is a really strong proof point. But let's look at the full picture here. The source material also says this segment just went out and spent $5.3 billion to acquire a company called Prolec. So how much of this incredible growth is from their existing business, and how much did they just go out and buy? It's a classic question. Are they building growth organically, or are they buying it? Because one is far more valuable and sustainable than the other. Are we seeing real strength here, or are they just juicing the numbers with a huge acquisition right out of the gate? Well, it's both. And frankly, that's the bull case. They're executing a bolt-on acquisition strategy perfectly. This wasn't some desperate move to buy growth. It was a strategic strike to increase capacity and capability in the absolute hottest part of the market: transformers. Prolec immediately adds $5 billion in backlog and is expected to contribute $3 billion in revenue this year alone. And get this, at over a 20% EBITDA margin. They didn't just buy revenue, they bought a high-performance, cash-generating asset that slots right into their existing framework, allowing them to meet the crushing demand they simply couldn't handle on their own. It's like adding a new state-of-the-art production line overnight, just as your orders are going completely vertical.
All right, the two main pillars, power and electrification, I have to admit, they seem strong. I can see the rebar, I can see the high-grade concrete. But every structure, no matter how well designed, has a potential weak point. And in this company, you don't have to look very hard to find it. So let's talk about the wind segment. This is where I expect to find the cracks. This is the part of the story the bulls on Wall Street really don't want to talk about, but we absolutely have to.
And here it is. There's no sugarcoating this. The wind business is bleeding cash. It lost $382 million on an EBITDA basis in this quarter alone. Revenue fell 25% organically. The margin collapsed by over 1,600 basis points. So while the other two segments are firing on all cylinders, this one is a five-alarm fire. It's a significant drag on the entire enterprise, pulling down overall profitability and just consuming cash that could be used somewhere else. This isn't some small leak in the basement. This is a gushing wound in a main artery. So the crucial point is this. How can you sell a story about leading the energy transition when your flagship renewables business, the one with wind in the name, is hemorrhaging money? It's a massive contradiction in the investment thesis. Management can talk all day long about data centers and gas turbines, but this problem isn't just going to go away. It completely undermines their entire ESG narrative. This isn't just a crack in the armor. This looks like a potential fracture in the company's core identity. That is the fundamental question for any investor in GE Vernova. This is what the entire debate really comes down to. Can the overwhelming strength in the other parts of the business overpower this one glaring weakness? So let's bring it all together for the final verdict. Because despite the massive $250 million drag from the wind segment, the company's overall strength was so profound that they took the incredibly confident step of raising their guidance for the entire year. Just look at this slide. They're not just inching guidance up. They're making substantial increases across the board. They're adding $500 million to the revenue forecast. They're adding a full percentage point to the top end of their EBITDA margin guide. And, most importantly, they're adding $2 billion to their free cash flow forecast. That is not a minor adjustment. That is a massive statement. Management is sending an unmistakable signal to the market. We know wind is a problem, but the strength in power and electrification is so overwhelming that it's more than enough to offset that weakness and still deliver a blockbuster year. So here's the final stress test summary. The bull case is built on a foundation of monstrous order growth, accelerating margins in their two biggest and most important segments, a fortress-like backlog that gives them years of visibility, and of course, the powerful secular tailwinds from grid electrification and the AI data center boom. The cash generation is elite.
But the bear case is simple and it is severe. The wind segment is a massive cash drain with no clear or immediate path to profitability. There's immense execution risk in converting that $163 billion backlog into actual profit. I mean, a big backlog is great until you fail to deliver on time and on budget. And they still face macroeconomic headwinds like inflation and the potential for new tariffs, which could directly impact that fragile wind business even further.
Our verdict: the foundation is structurally sound. The performance in power and electrification is not hype, it is real, it is powerful, and based on the backlog and the market dynamics, it looks durable. They have forged a very solid base for growth.
But it's a foundation carrying a heavy, unbalanced load. You just cannot ignore it. The wind segment is a significant liability that is actively undermining the strength of the other two pillars. The investment thesis here is a bet. It's a bet that the two strong pillars can carry the dead weight of the third long enough for management to either fix it, sell it, or shrink it into irrelevance before the market finally loses its patience.
And that leaves us with the final question for your portfolio. This quarter, the answer was a resounding yes. The growth engines were more than strong enough, but the market is fickle and one quarter does not make a trend. So the ultimate question here is one of endurance. Can they maintain this incredible momentum in the strong businesses while simultaneously stopping the bleeding in the weak one? The company has proven it has the strength. Now it has to prove it has the endurance. And knowing the difference between those two is how you forge a winning portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.